CBS News published an article today with a headline that stopped me cold. Will the price of silver hit $200 per ounce this March? CBS, not a silver blog, not a Reddit thread, not a YouTube channel. CBS News, one of the oldest and most conservative financial outlets in America, is now publicly asking whether silver can double from today's price within the next 25 days. 6 months ago, if you had told anyone on Wall Street that CBS would be running a $200 silver headline, they would have laughed you out of the room. Silver was $30. The idea of triple digits was fantasy. And yet, here we are, in March 2026, with silver at $84, up 200% in 14 months, and the mainstream media is now debating whether it doubles again before the month is over. But here is what CBS didn't tell you. Because while they asked the question, they did not have the 5 pieces of data that landed in the last 48 hours. 5 catalysts that just simultaneously aligned for the first time in silver market history. And when you see all 5 together, the question stops being, can silver hit 200? And starts being, what's going to stop it? Catalyst 1, the CME just cut silver margins from 18 to 14%. The first cut in 100 days after 6 consecutive hikes that crushed the price from 121 to 74. Catalyst 2, the U.S. economy just lost 92,000 jobs in a single month when Wall Street expected a gain of 140,000. Catalyst 3, rate cut expectations have exploded from 35 basis points to over 100. 3 to 4 cuts now priced in for 2026. Catalyst 4, COMEX. March deliveries have 52 million ounces, standing against 86 million registered, with 15 business days remaining. Catalyst 5, the Iran war has entered its 7th day, costing the United States $891 million per day, with the Strait of Hormuz still effectively closed and Dubai's bullion air bridge still grounded. Any one of these alone would be significant. All 5 hitting in the same 48-hour window. That has never happened before. And in this video, I'm going to walk you through each one and show you exactly how they connect to the $200 question that CBS just put on the front page. Let me start with why CBS is even asking this question, because the fact that they're asking it is itself a signal. Mainstream financial media operates on a lag. They don't lead trends, they follow them. By the time CNBC or CBS or Bloomberg puts a specific price target in a headline, it means the idea has already saturated institutional research desks, has been discussed in private client calls, and has reached a level of credibility where editors feel comfortable publishing it. CBS doesn't run $200 silver unless their sources, the analysts, the fund managers, the traders they quote, are telling them it's within the range of serious outcomes. And here is the specific context from their article. They note that silver hit $100 in January, pulled back to 70 in early February, and has been consolidating between 80 and 96 since then. They quote experts saying that the same forces that drove gold from 2,600 to 5,400 in 12 months, central bank buying, geopolitical tension, currency debasement, institutional demand, are now acting on silver. And they note that silver's historical volatility means it can move faster and further than gold in both directions. What they didn't have when they wrote that article was what happened in the last 48 hours. Because the 5 catalysts I just listed didn't exist when CBS was drafting their story. The margin cut was announced yesterday. The NFP was released yesterday. The rate repricing happened yesterday. The COMEX delivery data updated yesterday. And the war entered its most expensive phase yesterday. CBS asked the question based on the setup. I'm going to answer it based on the trigger. If this kind of real-time synthesis is valuable to you, if you want to understand what the data actually says instead of what the headlines summarize, subscribe and hit the bell. Because the speed of information in this market is the difference between being positioned before the move and watching it from the sidelines. Now let me break down each catalyst in detail, starting with the one that changes the mechanical structure of the market. Catalyst 1, the margin cut. For 100 days, the CME maintained increasingly aggressive margin requirements that suppressed leverage in the silver futures market. Every time silver rallied, the cost of holding a position increased, forcing liquidations and creating artificial selling pressure. This was the single most effective tool for keeping silver below $100. As of March 7th, tomorrow, that tool is being reversed. Margins drop from 18 to 14%. That is a 22% reduction in the cost of maintaining a long silver position. For a standard COMEX contract controlling 5,000 ounces at $84, that's a reduction from roughly $75,000 to approximately $59,000. $16,000 of capital freed up per contract. Across the entire open interest, we're talking about billions of dollars of buying power being unlocked. And here is the historical precedent. When the CME cut gold margins in September 2024, gold rallied 18% in 60 days. Silver's beta to gold is approximately 2 to 1. An equivalent move from $84 puts silver at roughly 114. That's without any additional catalysts. Just the margin cut alone, based on historical pattern, gets you to 114. Catalyst 2. The NFP collapse. Negative 92,000 jobs. This number is not a soft landing. It is not a gradual cooling. It is the labor market contracting for the first time since the pandemic shutdowns. The consensus estimate was positive 140,000. The miss was 232,000 jobs. That is the kind of divergence that forces the Federal Reserve to act regardless of what inflation is doing. And this connects directly to Catalyst 3, the rate repricing. Before yesterday's NFP, the interest rate swap market was pricing 35 basis points of easing for 2026, maybe 1.5 rate cuts. After the NFP, that number jumped to over 100 basis points, 3 to 4 cuts. The market went from higher for longer to the Fed has to cut aggressively in a single morning. Now here is why this matters for the $200 question. In the 2019-2020 rate cutting cycle, silver gained 114%. In the 2007-2008 cycle, the initial cuts preceded a period of massive monetary expansion that ultimately pushed silver from $8 to $49, a 600% gain. Every rate cutting cycle in the last 20 years has produced a minimum 100% gain in silver. 100% from today's 84 puts you at 168. And that's the minimum based on historical precedent during cycles that did not have a structural supply deficit, did not have a war-closing trade routes, did not have Chinese export controls. Catalyst 4, the COMEX delivery situation. This is the one that most people underestimate because the numbers are abstract until you realize what they mean in practice. 52 million ounces are standing for delivery against 86 million ounces of registered inventory. But that 86 million includes metal committed to ETF obligations, industrial forward contracts, and prior delivery notices. The actual freely available silver may be 40 to 50 million ounces, against 52 million standing. The math does not close. With 15 business days remaining in March, and with record delivery volumes in January and February, the exchange is facing a structural delivery challenge that gets worse every day. And starting March 7th, when margins drop to 14%, the cost of standing for delivery gets cheaper. More traders can afford to say, give me the metal, instead of rolling their contracts forward. Catalyst 5, the war. It's day 7. The cost has reached $3.7 billion according to the Center for Strategic and International Studies. That is $891 million per day. This money is not budgeted. It is being added directly to the national debt, which already stands at $38 trillion. The war has closed the Strait of Hormuz. 20% of global oil supply disrupted. It has grounded flights through Dubai. 20% of global bullion logistics offline. It has pushed oil above $85, feeding inflation expectations that make rate cuts more urgent and currency debasement more certain. And Nobel laureate Paul Krugman just told Fortune that the Iran conflict will be the straw that breaks the camel's back for the U.S. economy if it continues. The straw that breaks the camel's back. A Nobel Prize-winning economist is using language that describes systemic failure. And silver is the asset that benefits most from systemic failure because it is simultaneously a monetary hedge and an industrial necessity. Now let me show you what $200 actually requires mathematically, because CBS asked the question but didn't do the math. Silver is at 84, 200 is a 138% gain, sounds extreme, but silver gained 155% between December 2025 and January 2026, from 47 to 121, in 8 weeks. 138% over 25 days is aggressive, but within the range of what this specific market has demonstrated it can do. Path 1, ratio compression. Gold is at $5,100. The gold-silver ratio is 61 to 1. If the ratio compresses to 30 to 1, still well above the 1980 low of 17 to 1, silver hits 170. If gold simultaneously rises to 5,500 as JP Morgan projects, and the ratio hits 25 to 1, silver reaches 220. The ratio compression path alone, at conservative assumptions, gets you to the 200 zone. Path 2, rate cycle momentum. If the Fed delivers 3 to 4 cuts as now priced and the dollar index drops from 98 to 90, a historically normal response to rate cuts, silver's dollar-denominated price rises mechanically. Every 1% drop in the dollar adds roughly 2% to silver. An 8% dollar decline adds 16% to silver, taking it from 84 to roughly 97 before any fundamental buying even starts. Path 3, delivery squeeze. If COMEX delivery requests exceed available supply in March, the exchange either allows a price spike to attract metal or converts to cash settlement. Either outcome is a price catalyst. A delivery squeeze at the exact moment margins are falling and rates are being cut creates a multi-directional tailwind that has no modern precedent. And path 4, the war premium. If the conflict escalates further, if Iran hits Saudi oil infrastructure, if Hormuz stays closed through March, if the US deploys ground forces, the safe haven demand for silver could surge independently of everything else. The war costs $891 million per day. That money gets printed. Printed money devalues the dollar. A devalued dollar reprices silver. Here's the question I want this community to answer, because you have been more accurate than every analyst I've read over the last 3 months. Do you think 200 is possible by March 31st? Not probable. Possible. Because CBS is asking the question. Citigroup has 150 as a Q2 target, which means they think triple digits are coming in the next 90 days. Bank of America has 309 as a 12-month target. And the 5 catalysts that just aligned have never coexisted before. Drop your number in the comments. Not what you hope, what the data tells you. Because this community's collective intelligence is one of the most valuable things on this channel, and I rate every single response. Let me be direct about what I think happens and what could go wrong. I think silver breaks $100 in March. I don't know if it hits 200 by March 31st. That requires an acceleration of multiple catalysts simultaneously. But I think triple digits are highly likely within the next 30 days based on the convergence of margin relief, rate expectations, delivery stress, and geopolitical escalation. The base case is 100 to 120. The bull case is 150. The extreme case, the one CBS is asking about, requires everything to go right at the same time. What could prevent it? A ceasefire in the Iran conflict would reduce the war premium and reopen supply routes. This is the biggest short-term risk. A hawkish Fed surprise, if Powell or incoming Chair Warsh pushes back against rate cuts despite the NFP, would strengthen the dollar and pressure metals. The CME could reverse the margin cut if volatility spikes. They've done it before. And a broader market crash, if the economy deteriorates faster than expected, could trigger margin calls across all asset classes, temporarily dragging silver down with everything else. But notice what all of these risks have in common. They are temporary. A ceasefire doesn't refill COMEX vaults. A hawkish surprise doesn't close the supply deficit. A margin reversal doesn't create physical silver. A market crash doesn't reduce industrial demand for solar panels, AI servers, and electric vehicles. Every bearish scenario delays the move. None of them prevent it. Here is what's in your control. Understanding that CBS News is now asking the same question that Citigroup answered at 150 and Bank of America answered at 309. Understanding that the 5 catalysts that landed in the last 48 hours have never converged before. Understanding that the margin weapon, the single most effective tool for suppressing silver, was just holstered. And understanding that the clock is ticking. March delivery, 15 business days. 86 million ounces, 52 million standing. The math doesn't close. And starting tomorrow, it costs 22% less to stand for delivery. January took silver from 78 to 121 in 12 trading days. That was with margins rising, with supply routes open, with the labor market intact, with no rate cuts priced. Every single one of those conditions has reversed. The margins are falling. The supply routes are closed. The labor market collapsed. And rate cuts are coming. CBS asked if silver can hit 200 this month. Here's my answer. The setup that exists today, on March 6th, 2026, is the most bullish convergence of catalysts in the modern history of the silver market. Not because I want it to be, because the data says it is. Margin cut, job collapse, rate repricing, delivery stress, war escalation, 5 arrows, all pointing the same direction, all fired in the same 48 hours. You're watching this video at $84. The next time all 5 of these catalysts align at the same time will be never. Because this specific combination, a margin reversal after 6 hikes, a negative NFP, a war closing 2 trade routes, COMEX at 20-year lows, and rate cuts being repriced overnight, has literally never happened before. What you do with that information in the next 25 days is the only part of this story you can control. But at least now you know what CBS is asking, what the banks are targeting, and what the data actually shows. 200? I don't know. But I know the direction. And I know that $84 won't be the number on the screen for long.